Welcome to Premium Cashflow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
Welcome to another edition of Premium Cashflow Podcast. Today, I am delighted to welcome Ivan Barratt with Barratt Asset Management Company. I appreciate your time, Ivan. I'm looking forward to the conversation today.
Thank you for having me, Sakar. It's great to be here. I've been looking forward to this all week, and I hope I can deliver some value to your audience.
Absolutely, absolutely. For our audience who have probably not heard of Ivan, which I can't imagine, but Ivan is a rock star and a big presence in multifamily. His company, currently they own 3,000 units. Ivan has raised $80 million. So from his humble beginnings, he has come to a lot of success, and he has helped and grown his team and a lot of people around him. His company is a two-time Inc. 5000 private equity and management firm. Today, Ivan focuses on equity financing, acquisitions, and company strategy. So today we are going to dig into his story. Their company owns cumulatively about 300 to 350 millions of assets, comprising of 3,500 units. Boy, that is an impressive.
And I drink a lot of water.
Awesome. So you're still grounded, right? Good. So thank you, Ivan. I appreciate, I have been looking forward to this episode as well, as I shared, and I have always enjoyed your insights and your expertise on a lot of other Medium podcasts as well.
Thank you.
I definitely want to dig into your story as much as I think viewers will would like to rewind. Give us some background, Ivan, as to how you got started,
Sure.
and how you kind of transitioned towards multifamily, I should say.
Well, I'm lucky in some ways, many ways. I grew up with entrepreneurial parents. My father, an attorney, sole practitioner, and real estate investor. He had lots of rental properties growing up. And naturally, my brother and I became his labor arm over summers, mowing lawns, pulling weeds, whatever he could get us to do, which developed early sort of a disdain for manual labor. I still hate mowing the yard to this day. My wife loves making fun of that fact. But I also got this bug for real estate, and I thought, gosh, why would you want a real job? Why not just own a lot of income property and watch the rent checks come in? And of course, it turns out it's a real job, but it definitely stoked that entrepreneurial fire at a very young age. And
Awesome.
so by the time I went to college, Indiana University, great business school, I knew I wanted to be in real estate. So I got into the business school. Back then, they'd let anybody in. I think they took pity on me or my essay or something, and was able to squeak into business school, being a C+, B- student at best.
Sure.
And so I get out of IU with a degree in real estate finance and a background in real estate law and development, and it's a really great school within their business school.
Sure.
And I think I'm pretty smart. And I get a mentorship of father figures still to this day, working for a developer here in Indy. And I basically, my dad had a lot of lessons growing up and a lot of good sayings. And I got my foot in the door with my first mentor by saying, I will work for free. I'm here to work to learn, not to earn.
Sure.
And of course, he paid me something, and I got paid commission when I sold things. He was developing real estate, building condos for sale, great projects, developing subdivisions. He owned multifamily, so I got a taste of some asset and property management, zoning, acquisitions, market study, and feasibility, which still guides me today.
Absolutely.
And so now I'm thinking I'm really smart, right? And 2008 comes along.
Sure.
And all these millions of dollars in development project commissions that I'll make when we basically flip out of them goes poof.
Sure. And if I may, Ivan, when did you graduate and when did you start working for this developer? Around what year was that?
So I graduated IU in 2000.
Okay.
And I got my foot in the door with him, I think late 02, early 03.
Okay.
I got out of college and went back to a company that I worked for in their sales department, managing a sales team. Then I got some odd jobs working for some real estate guys, cataloging environmental sites, just some weird stuff because I didn't want to go the brokerage route.
Sure.
And I didn't want to be a cog in a big machine, and I wanted to work in development. I didn't know how to get into it at the time, and I got some good advice. Well, if you're going to be an entrepreneur, keep working on your sales skills. And so I did that until I could find the right opportunity in real estate.
Sure. And Ivan, if I may, you just indicated that you didn't want to go into brokerage, right? So typically a lot of folks will say, hey, I want to get into a real estate. And typically, especially when they're young, they kind of transition towards sales and brokerage side of the house. So was that sort of the guidance from your father or something, some learnings that you or experiences you had where you were thinking that, yes, I want to be perhaps into development? Was there something about it?
I really wanted to be in development. I wanted to understand how to develop, because at that time I thought I would be a real estate developer. I thought I would go out, acquire land, build projects, and then sell those projects. I had basically forgotten why I got into real estate in the first place, which was cash flow.
Sure.
And I basically got sort of distracted or seduced by the sexiness of being a real estate developer and building shiny objects and selling them. And at that time, you built it and people bought it. And I thought, wow, this is really easy.
Sure.
I'm really good at this. And then 2008 hits.
Sure.
And I find myself negative cash flow, negative net worth. I think I was about $200,000 in debt, negative like $5,000 a month.
Wow.
And had to work my way out of that. And figure out how to climb out of that from less than zero. At the same time, I'm soul searching. I'm reading all my old books again, trying to figure out how to stay in real estate. I am doing a little bit of real estate brokerage on the side, helping people buy and sell homes. A lot of land consulting because I was really good at that. And finally developed this idea, bouncing it off my brother. And my father, that I would start a property management company, which I absolutely hated and didn't want to do, but came to the realization that if I could do what I hated and I could scale a business around it, I could grow a cash flowing business, recurring revenue. I could build a company around that, and down the road somewhere I could do bigger deals.
So I can totally relate. Yep.
Yeah. Yeah, so I never did the single family route like you did. I was buying, but I managed a lot of single family for other out of town investors.
Sure.
And I started buying small multifamily deals with hard money, highly distressed deals and highly distressed sellers in about 2010 and forward.
Sure.
To where I could go in and I could use the bigger pockets burn method. Back then it wasn't called that.
Sure.
But exact philosophy that's been around for a long time. Buy, add a lot of value, lease the units, right? Refinance it with better terms, and repeat. Absolutely. And so I was doing that on small multifamily deals, duplexes, then a 6-unit. There's a triplex in there. In my market, there's a lot more duplexes than anything else.
Sure.
And then started buying some smaller deals, 35 units, 30 units. Then I said I'd never do another small deal again, and I bought 15 because it was too good of a deal to pass up.
Mm-hmm.
At the same time, I'm taking on management contracts, and I'm hiring people and learning how to manage teams and grow a company.
Sure.
Whereas today, you know, we're approaching, by the end of this year, probably 3,700 units, maybe 4,000.
Sure.
And very little third-party management anymore,
Sure.
because we really like controlling the entire leadership, and we don't like working for anybody else except our investors.
Right.
We've got our own way of doing things.
Absolutely.
Yeah.
And there's a lot of great things to unpack right from that, Ivan.
Yeah.
I would like to
unpack away, Sakar, whatever you want to poke around on. Go for
sure. It. You shared the story of your father that he owns rental units and stuff. So I'd like to perhaps go back to that, Ivan. That the belief in real estate as to a good vehicle that you want to own for the long term and have it as a career of sorts. What was your father instrumental, or the experiences besides cutting grass, I should say? What were those the experiences that kind of propelled you to say that, hey, you know what, this is where I want to be? And I'd like to follow up also by saying or asking rather that does your father still own portfolios now, or he's completely out of it?
So I'll go backwards. So my dad no longer owns real estate, except he invests with alongside me. We've got lots of friends and family in our deals, as well as investors now. And gosh, I think we're approaching 40 states and 3 or 4 countries in addition to the U.S. So just to expand on that, so my dad owns rental properties. His brother never graduated the 10th grade. I think that's right. He left high school as a sophomore.
I see.
And became a multimillionaire via owning. He bought a gas station. He bought it seller financed off of a guy. Then he bought another one. Then he started buying car washes. And he owned commercial real estate. And then I had an uncle on my mom's side who owned a couple apartment buildings. So I got this really early exposure to it. And when Rich Dad Poor Dad came out in 1996, my dad probably got the first running of that book and gave it to me. Said, hey, read this. So he was really into real estate. I think if he had had a time machine, he would have gone a different path. I was actually getting ready to go to law school, and I had sat for the LSAT, and I thought I needed more schooling, and I thought being a lawyer or going through law school and then getting into development would be a great track. A lot of guys have done that. And my dad says, Sakar, he says, don't go to law school. He said, at the end of the day, you're still an hourly employee. He said, be an entrepreneur and hire great attorneys.
Wow.
And that hit me like a ton of bricks, because it's coming from my dad, who's an attorney.
Wow. Yeah. Profound advice. And what you stated, Ivan, is very correct. As experienced folks who are in the industry, been around for like, let's say, a couple of decades, they know that there are a lot of veterans from 60s, 70s, stuff like that, who owned a lot of mom and pop, like, let's say, the buildings, the gas stations, the car washes. And we all have seen those folks or heard of those folks and what that sort of generational wealth that has done to their families. So it is, and
have you crossed with KK Singh yet? Have you guys crossed paths?
I have, and I relate to that story as well with all the gas stations.
I've got a good story for you. So KK's son Yuvi actually works at BAM.
Oh, nice! Incredible.
He's been an intern here now for, I think, 2 years.
Incredible.
And everybody loves Yuvi. And I remember when KK asked me to talk to him because he'd be coming to Indianapolis to study, and he needed a job. And I said, sure. I tell my partner, he's the yin to my yang. So much credit for our success.
Sure.
Master operator. master at being president and CEO of BAM.
Mm-hmm.
I say, hey, I want to look at this kid. He's like, hey, I'm too busy. What are we going to use an intern for? And I said, listen, just meet with him. You decide. It's up to you. I don't care if you hire him or not. I'll tell his dad, either way, he'll be fine with it.
Sure.
So UB comes in and tells his stories about working for his dad's gas station, the night shift, collecting rents at KK's rental properties.
Sure. Mm-hmm.
Adam comes out of that interview and he comes to me, he's like, I don't know what we're going to have this kid do. I don't know where we're going to put him, but we got to hire him.
He can do it all.
We'll use him somehow.
Yes.
Right?
Yep.
And I find that so significant because, so many parents out there focus on, the report card and learning an instrument and, being in the play and like all these things to get their kid into this corporate machine.
Sure. Mm-hmm.
And then you've got these other cultures that I find so fascinating. It's like, hey, you're going to collect rents. You're going to work the convenience store. Right. Mm-hmm. And it's like that kind of a resume opens up so many doors for young people. And so many are unwilling to do it.
True. Very true. Very true. And for listeners, just to maybe give some context, KK Singh is another multifamily investor friend of our mutual friend of ours. And that's his
phenomenal human being.
That's his son that Ivan is describing. And on a related note, Ivan, I was just reading yesterday that within the Charlotte and sort of the Carolinas, more than 50% of the hotels and motels are owned by immigrant families. More than 50%.
I believe it.
That is an astounding stat. And I have been to, sort of your neck of the woods within Indiana and Ohio's of the world, where I know there's a lot of Asian hotel owner presence as well. And I'm sure you can relate to that as well. But
it's perspective, right?
Sure.
It's almost that mentality of delaying gratification and working hard for the next generation.
Sure.
Right. Whereas some folks maybe born here feel a little bit more entitled.
Sure. Mm-hmm.
And it's as a young father, it's really fun to watch a man like KK, be successful with his kids. And my wife and I were just talking about this on date night last night. Mm-hmm. At what age would it be appropriate to have our oldest son get dropped off at the maintenance shop at one of our apartment projects for the day, right?
Sure.
And I said 9, she said 10, so I think it'll probably be 10.
Interesting.
But that's the kind of focus we have in hoping to develop more entrepreneurs in our own family and no wage slaves.
Sure.
If you know the term.
Absolutely. And thank you for that detail there, Ivan. And for our listeners, it's important to share sort of the values, the work ethic that goes into these things. And that's why I wanted to go back to that sort of element of your background, wherein, like once you have that work ethic, you've seen how you are fixing the plumbing or the mowing the grass or, calling and scheduling the appointments for all different, let's say the showings or the maintenance. Once you see all those details and as big as you are right now, your belief into, I think, owning that property management yourself and running the show yourself goes a long way, because I think the amount of, NOI increase, as we call it, or the value that you can provide is astounding. Wouldn't you agree, Ivan, on that?
Well, there's a couple sides to that. And you're right. We're finding the third stool of value for our investors is our management team's ability to drive down costs. Primarily through technology, but also because we're in the nuts and bolts.
Sure.
And this is a game of pennies. Nickel
game
and
of
dimes.
Efficiency. Absolutely.
Yeah, nickel and dimes are great, but it's really a game of pennies, right? Every dollar we add to the bottom line can be anywhere from $17 to $20 of value to the asset.
Absolutely.
And then this beautiful thing happens when you own your management team, and the management piece is not a profit center.
Sure. Mm-hmm.
Its directive or its mission is to be this beautiful machine of people who have wonderful tools, who can execute our business plan. Without them, it doesn't matter how good I do on podcasts and raising capital or how good the deal is.
Sure. Mm-hmm.
It's the execution, right?
Absolutely.
And so
Absolutely.
instead of being miserly with how we pay people
Mm-hmm.
and how we manage our own expenses,
Mm-hmm.
we take what would be at best maybe a 10 to 15% margin, similar to like maybe a restaurant,
Mm-hmm.
sort of a low margin business.
Mm-hmm.
And instead, because that's not where we get our wealth,
Mm-hmm.
mine, my partner, or our investors, we reinvest that back into the business.
Awesome. Mm-hmm.
And this amazing simple thing happens when you pay people well, you treat them well, you have good culture, you get better people banging on the door to work for you,
Absolutely.
and they tend to stick around longer and do a better job. And
Couldn't
so
agree
for us,
more. Mm-hmm.
so for us, it's about growing our people, having a good environment, which isn't always the case in property management. It's a very tough job, right? How do you make it fun? How do you offer career progression for those that want it? And how do you make it a place that feels a little bit like a family, no matter how big it gets? And we have a lot of folks here that have taken that idea that I started with, and now I get almost zero credit. They get all the credit because they believe in our vision. It's not just something on a piece of paper.
Sure.
It's real. And so you get to see this culture, this beautiful machine grow, filled with beautiful human beings who are just as invested in success as we are. And
Sure.
we're heavy on Slack. That's how we communicate across these folks that are all over the Midwest now.
Mm-hmm. Mm-hmm.
And it's just so fun. I'm almost like a proud dad in a sense, in watching this organism grow, and
Mm-hmm.
these folks run their respective departments and even grow leaders underneath our leaders. It's truly almost sometimes speechless when I stop to think about what we've done here and the impact of the key people, the executive team, but then all the way down to the person picking up trash,
Sure.
on site, right?
Sure.
And how do we
Sure.
treat that person right? And how do we keep them around and make them feel valued? Because gosh, the places would fall apart without that person.
Couldn't agree more. I totally can relate, and I'm a much smaller player with respect to that. But the same values, the same sort of the vision, and exactly what we do, whether in our company as well. Like literally the same contractor that I have been working with him for like more than 15 years now. I've seen his kids, and I mean, and there are a lot of them like that, and we love to reward, maybe give them some extra help when they're buying the trucks or the houses and whatnot. And it's the same exact thing, is that once you have the buy-in, once they believe in you, my God, the type of execution and the type of customer service they give is simply unbelievable. And one of my, I think, really proud moments is like sort of on the Christmas, around the Christmas time, when I'm giving like either is this the Thanksgiving gifts, or around the Christmas, I'm giving them like literally like double bonuses sometimes. And I love that fact, because I said,
Nice.
what, you are the guys who are like making it happen. A lot of times I'm just on phone calls, but you are the guys going on running, whether it's rain or shine or hot or cold, you are the guys who are keeping everything running and doing things right. So this is the best part, that I mean, I'm sure that's like heart cherishing as much as it is than just all the other
Absolutely.
number. So good. Awesome. Boy, you added a lot of value in right out of the gate, Ivan, so I appreciate it.
My
So
pleasure.
let's talk some of the strategy and some of the sort of the mechanical side of things, Ivan, here, right?
I'll do my best.
So explain us, Ivan, that how was your sort of first syndication deal, or I don't know whether it was a joint venture of sorts. Kind of help us understand when was your realization came that you want to be in sort of bigger properties, and you want to, more importantly, start syndicating the larger assets.
from a very early age, I would always want to scale the formula, right? So
Sure. Mm-hmm.
even in my early 20s, I would think about, wow, if I owned 100 duplexes or 200 duplexes, how would that look? And then as time grew on, like, I want to own these bigger apartment deals. I very quickly realized that they have much better economies of scale. And in some ways, that was an obstacle to getting started at a young age, because I thought, I'm not going to mess around doing some small deals. I want to get into these big deals, right?
Mm-hmm. Mm-hmm.
And going back to my father, in that soul searching in 2008 and 9, out of nowhere, this saying that he had preached every chance he got that would really annoy me as a kid.
Mm-hmm.
The journey of 10,000 steps starts with the first one, right?
Absolutely.
And then all of a sudden one day, I couldn't tell you where I was or what I was doing, but I'll never forget that I put units for steps. And it was an ego check. And I thought, okay, the journey to 10,000 units, I've got 2 right now. It starts with the next deal. It doesn't matter how big the deal is. I just got to go out and do a deal.
Sure.
Right.
Mm-hmm. Mm-hmm.
And then worry about the next deal and putting that foot in front of the other, and stop looking at the summit that will never get closer if I don't start hiking up the mountain.
Sure. Mm-hmm.
And so I started taking that approach, and I stopped thinking about big deals for a while. I started doing my little deals and continued to graduate up. The first few apartment deals, the 35, the 30, the 15, it was an operating agreement with one investor who put up most of the money. Different investors in the deals, but one person would put up the money. $100 grand, $150 grand, and we would buy the deal, and I would throw in my real estate commission, whatever spare change I had,
sure,
right?
Sure.
And then we would have a preferred return in a split. My first real syndication with a private placement memorandum would be my 60-unit deal I bought in 2013. Sold that in late 18, I want to say. Don't quote me on the dates. It's on my track record, I think. Late 2018, 5-year hold. My worst IRR to date, but it was still 17%.
Wow.
Learned a lot on that deal. Certainly made some mistakes, but luckily was conservative enough in the underwriting and had my own management company and hustled hard enough to get the ship back on track. We refinanced it, and a couple of years later, as the market continued to improve, we sold it to the next syndicator.
Interesting.
And then from there, 5 years ago, this month actually, my partner and I sort of found each other. He was in the business, came on board to work with me just on the apartment side. On the deal side, we were going to work on deals together. And unfortunately for him, I discovered how great of an operator he was, and continued to give him more and more of the reins and control of the management company. Whereas today he's the COO, and the executive team reports to him. And I have to practice a daily discipline of staying out of their way as the entrepreneur that tends to get in the way, and it needs to learn to elevate and delegate.
Sure.
Gotten a lot better at it than I used to be, but it's still a daily practice.
Awesome. Thank you. And I couldn't agree more that I think at the scale and the size you are, Ivan, I think you need able firing partners on all different ends that can, sort of take the reins and run with it, right?
It's a team sport.
Absolutely.
Big time. And the more you can figure out how to tinker and put in the right parts and cut out the ones that aren't working and grow a team, the better. And focusing on A players attracts more A players.
Sure, sure. Now, a couple of few related questions there, Ivan. As you are growing bigger into sort of, let's say, from 15, 20, 35 unit type of deals, now you are
Yeah.
trending into 60 unit deals and things like that. So they need, like, let's say when you are bringing on the investors and stuff, like, um, were you savvy enough to underwrite those deals, kind of the type of perhaps the on a 300 unit type of underwriting that you may be doing now? I'm sure it has a lot more complexities now versus then. So I want to, kind of delve into when you started doing the 60 unit deal, like let's say your first deal, did
Yeah.
you, were you like savvy enough to understand all the preferred returns and the waterfalls and stuff like that? Was it that technical, or was it something like, hey, I know this is what I did on the 35 unit deal, on this 60 unit deal, maybe I can get couple of more partners and I know I can give them some cash flow and some piece of the pie? So was it more of that napkin math type of thing, or were you like properly underwriting the deal per se?
One of the things that was really beneficial to going through business school was learning the ins and outs of Excel and real estate modeling.
Mm-hmm, mm-hmm,
So I actually got to take a class in it.
mm-hmm.
Now, the good news is for your audience, there's tons of ways to get that same information. You don't have to get a fancy degree from a Big Ten college to get that information anymore. But
Sure.
I was very insistent on taking those models and developing them as I continue to grow. So
Mm-hmm,
my model that I took away from college kept evolving,
mm-hmm,
and then I would put on and bolt on more pieces as I went. And before I started doing deals with investors, I was able to take others' models
mm-hmm,
that had been given to me and add those in as far as the waterfall. I
mm-hmm.
knew it. I knew it conceptually and understood. It's a very simple private equity model. It's nothing new.
Sure. Mm-hmm.
The LP GP structure and preferred interest and splits and waterfalls, those sorts of things.
Right.
And I wanted to have a really good handle on that before taking other investors' capital. Now,
Mm-hmm.
the mistakes I made were not in the math so much as in the what can go wrong, and thinking owning a 30 unit and owning a 60 unit are the same thing. They're not. Just like a 30 unit is not the same thing as owning 15 duplexes.
Sure.
Right?
Sure.
You've got more residents in one place. You've got more maintenance, more common area issues, that type of thing I could have pro formed better than I did going into it.
Sure. Mm-hmm.
But at the same time, I didn't let that get in my way. I didn't want to get bogged down in analysis paralysis. So I always put in these big fudge factors in the beginning,
Mm-hmm.
so that I knew I'd be making mistakes.
Mm-hmm. Mm-hmm.
And the way I've sort of always approached this is I'm going to fail small and fail early,
Mm-hmm.
so that by the time I get to that 60 unit, I've learned some valuable lessons that will cost me less
Wow.
on a
Mm-hmm.
15 or a 30 unit than will
Mm-hmm.
cost me on a 60 and on 112. And, I had a 30 unit heavy reno deal,
Mm-hmm.
almost freaking killed me. I learned so much on that deal, and I wanted to go through that on 30 versus 300 because 300 would have killed me.
Right. Right.
And when I say killed, I mean I would have had to do a capital call, or the project would have gone
Sure.
back to the bank, or
Mm-hmm.
something bad would have happened.
Sure.
And I
Sure.
wanted
Sure.
to have that body of experience before taking on investor capital. But I also realized at a young age, relatively, that to scale and grow real estate, it's not location. I'm going to quote Ken McElroy here. It's location, financing, and partners. You need partners. You need capital to
Absolutely.
scale real estate. It's expensive. It takes a lot of cash to buy it.
Sure.
And so you got to figure out all those pieces as an entrepreneur in the space.
Absolutely. Capital is such key, such key. Now, as moving on, Ivan, as you started to grow, right?
Yeah,
Have you changed your parameters in terms of, what class of property you are buying and things
big
like that?
time.
Okay. Help us walk through, like, sort of your experiences and mistakes and things like that.
Yeah. So, finding alpha returns for our investors. Alpha for us is maintaining returns and reducing risk
Mm-hmm.
versus shooting for higher returns.
Mm-hmm.
Our returns are already pretty great. We're if we liquidated everything today, I think we'd be 22 and change as far as an annualized return.
Mm-hmm.
So our approach has been taking more and more risk off the table as we got later and later in the cycle. So the last 2 years, 2018 and 19,
Mm-hmm.
the goal always starts off the same. We want to buy 1,500 to 2,000 apartments. Well, in 2018, we bought maybe 800 and change,
Mm-hmm.
not for lack of capital, but for lack of deal flow. And then in 20, same thing, lack of deal flow. We closed on a little over 500 units.
Mm-hmm.
This year, we're already seeing better deal flow thanks to the pandemic.
Mm-hmm.
But we've moved away from C class and are now focused for us on A- and B+,
Mm-hmm.
to where the upside is still a high teens rate of return. We really look for the ability to deliver 2.5x
Mm-hmm.
our investors somewhere between years 5 and 7.
I see.
If we hit it in 7, it's like a 16. If we hit it in 5, it's 18 and change IRR. But we really look for that target multiple.
Mm-hmm. Mm-hmm.
And we're out there buying businesses, Sakhar. So we want a business that's been reasonably well run already,
Sure. Mm-hmm.
but will benefit further in a market that's still growing.
Mm-hmm.
The ability to raise some rents through value add, traditional value add,
Sure.
changing out cosmetics, upgrading amenity packages.
Sure.
And third, our management team coming in and adding value.
I was just waiting for that.
Yeah, and that's how we're still getting those returns. Is that
Mm-hmm.
I don't know how we do it without having our internal management team right now. And I want to just be clear, when I say A- or B+, we are still in the workforce housing space.
Mm-hmm.
Although I would say we're more on the upper end of workforce.
Mm-hmm.
But we still seek a delta or a change or a difference between new product and our as reno rents or as renovated rents of anywhere from $500, $750 a month difference or delta. So we still want a big spread from luxury,
Mm-hmm.
but we take a little bit of risk off the table in the Midwest by buying 1990s, early 2000s vintage deals
Mm-hmm.
that they may not do a 25% IRR,
Mm-hmm.
but they're highly confident in delivering a 16 or better.
I see. Good. Thank you for that detail, Ivan. Now,
Yep.
In that
and the air's thinner when you're buying $25-30 million deals to car. There's less bidders at the table.
I hear you there. I hear you.
Yeah, I'd love to do some heavy value add C stuff, man, but I can't find anything where I can get a 20 to 25 or better internal rate of return, and that's what I need for that kind of risk in my market.
I see. Now, speaking of the market, Ivan, help us understand how is, sort of Indiana in general, or sort of some of the cities that you are investing. You stated you are branched out in Ohio as well. Help us walk through, you have such a large presence in a lot of cities within Indiana. So maybe is Indiana growing, or are there a lot of jobs? Help us understand how the market is.
Yeah, Indianapolis is at the forefront of Midwestern growth. It's a Cinderella story, successfully decoupled from the Rust Belt or manufacturing economy of old. Yes, there's still advanced manufacturing, but there's financial services, education, government, huge in logistics. We're buying a deal in August. Built in 2004, straight down the fairway value add deal for us, mostly management and a little bit of improvements to the property. FedEx, second largest hub in the world, is at our international airport right up the street from this asset. So Indianapolis has got a lot of things going for it. For your audience on the West Coast, it's a Salesforce hub.
Wow.
It bought a big company here years ago called Exact Target, and now Indy's a Salesforce hub in the Midwest. There's growing technology, bioscience. Lilly, which is a big pharmaceutical firm, is homegrown here.
Mm-hmm.
Cummins, which is a global engine
Sure.
maker all over the world, is headquartered here in central Indiana. And it's still sort of off of a lot of people's radar, although that's changed a lot in the last few years.
Mm-hmm.
I can find submarkets in what I would call the Indianapolis solar system,
Mm-hmm.
where I can get a better going in cap rate than that same asset might be in other markets. And there's still enough growth here. My favorite stat: the last 35 years, the average rent growth in Indy has been almost 3%, 2.9%.
Very healthy. Very healthy. Awesome.
Indy doesn't boom, Sakhar. It doesn't bust either. It's the
Sure.
tortoise versus the hare.
Right.
And it matches very well with our investment thesis. We're not aiming to hit home runs here, although we do hit them, maybe one or two out of five.
Mm-hmm. Mm-hmm.
But we're aiming for first and second base. Rule number one: don't lose money.
Sure. Mm-hmm.
Rule number two: remember rule number one.
Right. Mm-hmm.
Then rule number three is how do we make returns? And
I know,
that's
I
the
think
part of the portfolio that we offer for our high net worth individuals and families.
Right. And you have, as you shared before as well, you have like sort of so many proprietary sort of secret sauce going on there. And I'm a firm believer in what you said there about, also sort of the management play, because I think reducing those expenses and knowing sort of, what exactly you can do. And so that when you are maybe studying the sort of the rent rolls or, the all the income statements of properties, you can probably spot the inefficiencies very quickly because you've seen it, you've done it so much that you know what your payroll numbers are or contract services numbers are.
Yeah.
Would you agree?
Absolutely. Yeah. So we, because you have to move so fast now on deals, we do the bulk of the underwriting before the LOI ever goes out. Before we even tour the property, we've underwritten it first pass.
Mm-hmm.
And because we have that internal management team, we know what a property built in 2004 by a certain apartment builder.
Mm-hmm. Mm-hmm.
We know exactly if there's anything wrong with it. We know exactly what it's going to take to run it.
Sure.
We know what we're going to spend per unit on the reno. We know what it's going to cost to switch out the old tired gym equipment with new gym equipment and yoga and fitness on demand. Mm-hmm. We know all those costs down to the penny. Wow. And so we can move a little bit faster. Mm-hmm. And thankfully, we got started long enough ago that we've got a really, really solid track record, of course, with our investors, but also with the biggest brokers. Mm-hmm. Who are really our outsourced acquisition team.
Absolutely.
At our level, broker relationships are everything. At $25, $30, $35 million assets, mm-hmm. We do not go direct to seller. Our off-market deals still come through brokers. We would never violate those relationships. Mm-hmm. We value them so much.
Absolutely.
And we're grateful to be at the top of their lists. Now that the deal flow is getting a little bit better, thanks to the pandemic.
Sure. Give us some idea, Ivan, about some of the sort of the value adds that you may have done in some of your assets as to, maybe external improvements or some internal amenity packages that you have done, and, what sort of cost you are doing them at and what sort of rent bumps you're seeing.
I know you like to get into the mechanics here. We look for deals where we can do $150 to $200 a door in 36 months. Mm-hmm. Mm-hmm. In 36 months, I don't think we're doing anything crazy on amenity packages, but we're upgrading clubhouses, pool furniture, the gyms, bark parks, that kind of thing. Nothing crazy. Mm-hmm. And some of the ways that we renovate units and the costs associated with that is none of your business.
Good, good. All right. I appreciate that. No problem. And that's the secret sauce that I'm saying is that a lot of times you know your costs, you have your vendor relationships and things like that, right? So
Anybody that's dedicated to this and
sure,
really wants to do well at it can figure it out.
sure.
It's really not rocket science.
It's not.
It's a daily discipline and focus.
Absolutely, absolutely. Thank you. And now, Ivan, growing as big as your company has grown, help us understand, like when you started, like let's say you were at 1,000 units, 15 to 1,000, give us a sense of like how your responsibilities changed and evolved over time.
A lot of my so as you mentioned earlier, I was a solopreneur in the beginning. I did everything. I got up to 70 units, and I was the leasing agent, the property manager, the maintenance coordinator. I had a bookkeeper coming in every other week, so I didn't screw up the books. But I was everything else. Over time, you have to. What got me there wouldn't get me to the next thing. So over time, as an entrepreneur, you start having to learn how to manage people and teams, and that makes the real estate look easy most days. I had to get better at giving more responsibility away, letting people learn the hard way, letting them fail forward, which is very hard for me to do when I think I know everything, and getting humbled and learning to get out of the way. Today, we've been through a lot of training together and coaching and structure. Today, I focus a lot of my time on doing things like this, speaking with investors, because my favorite thing is to look at the macro strategy, look at the markets, look at what the Fed and the Treasury are doing, making investment decisions. And then I have fun because I get to push the team. Who's our next key hire? What does our company look like in 6 months, a year from now? How does our marketing change? How do we stay at the forefront of being a best in class when it comes to property management and investor relations? And so I get to sort of ask these big questions and make sure and push the team on focusing on these things. They've got their goals and their quarterly rocks as well, and they're doing awesome at that, which allows me to sort of stay at a much higher altitude, and I get to now look at the whole chessboard a lot more often and figure out where we want to go next. And I have the humble ability to bounce just about everything off my partner. And I would say 60% of the time he tells me I'm wrong, and maybe even more than that, and pokes holes in my ideas, and it's great. And a few of them get through his underwriting and help us run faster and play bigger.
Awesome. Thank you, Ivan. It's been a pleasure. I know your time is limited, and there's a lot more that we can go into for sure. But some of the questions I think for you are like very, I think dry of sorts, and that's why I like to, maybe perhaps stay higher level and ask the bigger questions. It sounds like, based on I think what you stated there, Ivan, looks like you have implemented EOS process within your company. Is that kind of where you are going with the quarterly rocks and things like that?
Oh yeah. We've been on EOS now for maybe a year and a half, and it's definitely probably top 3 game changers in the last 24 months. It's taken our team through EOS. It's really been helpful in scaling the company, getting everybody on the same page, growing that vision, that mission, having those quarterly rocks and goals that everybody is accountable to.
Sure.
And further separating who's accountable for what.
Sure.
It's been a great process for any aspiring entrepreneur that's gotten to a plateau and is looking to grow again and needs help in that organization, how to conduct meetings, how to grow, have accountability. I would say start with Traction or Rocket Fuel, those books.
Sure.
For the record, I didn't read either one of them. I just was told by other entrepreneurs, hey man, do this.
Sure.
And I'm a fire ready aim guy.
Right.
So I said, hey team, I want you to hear this guy talk for 90 minutes.
Right.
Let me know what you think. And they were like, yeah, this seems like a really good system. And so they decided to move forward with it. I was honored to be a part of the process. And now they took that proverbial baton and are running hard with it. And it's, again, I'm like a proud dad watching them grow and grow leaders underneath them.
Sure. Thank you for your candid, detail there. I have a couple of last questions. You're big in property management and owning and managing your assets, right? So if you were to now branch out into, let's say, nearby submarkets or a close by sort of state next to you, how would you do that? Would you maybe perhaps acquire to get more scale before you can stamp your own management company, or would you perhaps maybe do a third-party management? Give us some sense of your.
No way, Jose. We will definitely go to additional markets that are a little bit farther away.
Mm-hmm.
But we would absolutely have to have on-site, boots on the ground, BAM employees.
Mm-hmm. Mm-hmm. I see.
Yeah,
I
no
see.
question. Even if our company lost a little bit of money with the first one.
Mm-hmm.
Not the investors, but even if it cost our management company
Internally more,
at a loss, we would use that as a loss leader to enter a new market. We would not go to a market and hire third-party managers. I've seen guys like me do that out of ego just to go to a new market, and I've seen people lose deals and have big capital calls because they screwed that up. And
Awesome.
And it's not a question of if we'll go, but when. But we'll be disciplined in our approach and we'll stick to our knitting.
Awesome. Thank you. And one last question, Ivan.
Sure.
Give us a couple of awesome advice or some discipline that you kind of stay at or remember in your mind all the time as you are perhaps conducting daily activities or, evaluating deals or what have you. Give us some pieces of some just sort of foundation rocks that you always kind of stay by.
Yeah. As a capital raiser, I'm always stuffing the pipeline, always filling my pipeline of potential relationships.
Mm-hmm.
I don't need your money, Sakar, but I want it. And if my thesis fits your portfolio, let's be partners, right?
Sure. Mm-hmm.
I still use my dad's sayings. My favorite, by the inch, it's a cinch. The journey of 10,000 miles starts with the first step. So I try to stay disciplined at having a goal, but then not looking at it too often and just focus on every day. How do I put one foot in front of the other? How do I keep momentum going in the right direction? And then you can look back, right? And you can see how far you've come up the mountain. You can see how far you've come as a father or as a husband, which are other areas, and still trying to, keep high grades in. I screw up plenty, but those things are even more important than how many zeros are in the bank. For me, in any entrepreneur, I highly recommend getting into EO, which is Entrepreneurs Organization, or YPO, which is the next level up.
Right.
Surrounding yourself with other people that are trying to do the same thing. You are who your friends are and who you network with. That's so true. And peer-to-peer learning is a great way to keep those fires stoked.
Absolutely. It's been wonderful, Ivan. I appreciate your time. I know there was a broad stroke of answers, and this was a podcast where we say that, the devil is in just taking the advice, understanding those momental points that you stated, rather than just the minutia of technicalities sometimes we get into. And I appreciate your time and sharing the broad, sort of the background, the different practices you do. So it's been a pleasure having you. I hope I can, reach out to you again in future for some more, detailed questions and have another fun podcast.
The pleasure's all mine, Sakar. It was a really fun conversation, and I enjoyed your the way you host your show and how it's the conversation goes. It was a lot of fun. I could go for another hour if I had the time.
Sure. As humble as you are, I totally appreciate it. Thank you, Ivan. It's been a pleasure.
Likewise.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.